Episode 135. What is a crypto index fund? And should you use one? In traditional investing, the index fund revolution changed everything. Instead of trying to pick individual stocks that would outperform, a task that the majority of professional fund managers consistently fail, you could simply buy the entire market at minimal cost. A fund tracking the S&P 500 gives you ownership of the 500 largest American companies in proportion to their market capitalization. When the market rises, you rise with it. When it falls, you fall, but you fall alongside everyone else, not faster. The data on index funds versus active stock picking is overwhelming. Over a 10-year period, more than 80% of active fund managers underperform their benchmark index after fees. The lower the fees and the broader the diversification, the better the outcome for most investors. The same logic has now arrived in crypto. Crypto index products, funds, ETPs, and on-chain index tokens allow you to gain exposure to a basket of cryptocurrencies in proportion to their market capitalization or some other weighting methodology, without selecting individual assets. And in a space where picking which altcoin will outperform Bitcoin over the next cycle is genuinely difficult even for professionals, the case for broad market exposure is compelling. Welcome to Crypto for Beginners. I'm Robin. Today we are covering crypto index funds and index products, what they are, how they work, what is available in 2026, what the real advantages and limitations are, and how to think about whether they make sense for your portfolio. The case for indexing in crypto. The core argument for crypto index products rests on two observations. The first is that crypto markets are dominated by a small number of assets by market capitalization. Bitcoin represents approximately 56% of the total crypto market cap. Ethereum accounts for roughly 10%. Together, Bitcoin and Ethereum are nearly two-thirds of the entire market. An index product that weights assets by market cap will therefore be heavily concentrated in Bitcoin and Ethereum, the two most established, most liquid, and most institutionally adopted cryptocurrencies. The second is that predicting which specific altcoins will outperform in any given cycle is extremely difficult, even for people with deep domain knowledge. Projects that appeared promising and were widely recommended at the start of the 2021 to 2022 bull market included many that subsequently lost 90% of their value or more and have never recovered. Projects that massively outperformed in the same period were often not the ones that analysts had identified in advance. An index product that holds the top 10 or 20 assets by market cap will naturally include whatever emerges as dominant, because those assets' market caps grow as they succeed. This is the same logic that makes equity index funds effective. They automatically overweight winners and underweight losers as market cap shifts reflect relative performance. What crypto index products exist in 2026? The crypto index product landscape has expanded considerably in recent years, offering options across different formats and risk profiles. The DeFi Pulse Index and related on-chain index tokens were among the earliest implementations. These are ERC-20 tokens deployed on Ethereum that represent a basket of assets, typically top DeFi protocol tokens, automatically rebalanced according to a defined methodology. You buy one token and gain exposure to multiple underlying assets. The rebalancing happens through smart contracts that buy and sell underlying assets to maintain target weightings. The Index Cooperative, a DAO that manages several index products, is the primary issuer of these on-chain index tokens. Bitwise Asset Management offers the Bitwise 10 Crypto Index Fund and the Bitwise Bitcoin ETF. The Crypto Index Fund holds the top 10 cryptocurrencies by market cap, weighted proportionally, and rebalances monthly. It is available as a regulated investment product in the United States through private placement to accredited investors and through secondary market trading. Bitwise has been one of the most transparent and research-focused operators in the institutional crypto space. CoinShares, Grayscale, and several European exchange-traded product issuers offer regulated crypto basket ETPs, exchange-traded products that can be purchased through traditional brokerage accounts across European markets. These track indices of varying composition, some holding only Bitcoin and Ethereum, Others holding broader baskets of the top 5, 10, or 20 cryptocurrencies by market cap. In 2026, the development of multi-asset spot crypto ETFs in the United States is in progress. The approval framework established by the Bitcoin and Ethereum spot ETFs has opened the door for broader index products, and several asset managers including BlackRock, Fidelity, and Bitwise have made filings or signaled intent to offer multi-asset crypto index products through traditional brokerage infrastructure. Bitcoin and Ethereum allocation. The core question for most investors considering a crypto index, the central decision is not which index to use. It is how much Bitcoin versus Ethereum versus broader altcoin exposure is appropriate. A market cap-weighted index of the top 10 cryptocurrencies in 2026 would be approximately 60 to 65% Bitcoin, 10 to 12% Ethereum, and the remaining 25 to 30% divided among Solana, XRP, BNB, and a handful of others. This is a relatively conservative allocation, heavily weighted toward the most established assets, which is appropriate for investors who want crypto exposure without taking concentrated bets on any particular altcoin cycle performance. For investors who believe strongly in Ethereum's dominance of DeFi and smart contract applications, or in Solana's growth trajectory, or in any other specific thesis, a concentrated position in those assets may make more sense than a broad index. The index argument is strongest for investors who do not have a specific conviction about relative performance and want diversification within the crypto asset class. The fee question, one of the most important factors in evaluating any index product, is the ongoing cost. Fees compound over time and meaningfully reduce long-term returns. On-chain index tokens, like those from Index Cooperative, charge streaming fees, typically around 0.95% annually, deducted from the index value continuously. This is competitive with the cost of rebalancing a portfolio of individual assets manually when you factor in gas fees. Institutional index products like the Bitwise 10 Crypto Index Fund charge higher management fees, historically around 2.5% annually, that are more expensive than the cheapest single-asset ETFs, but reflect the cost of managing a regulated, multi-asset product with monthly rebalancing. For European investors accessing crypto index ETPs through traditional brokerages, costs typically range from 0.5% to 1.5% annually, competitive with the cost of holding multiple separate crypto positions on an exchange that charges trading fees. Compared to the cost of buying and rebalancing 10 to 20 individual crypto assets on an exchange, accounting for trading fees, spread costs, and the time and attention required, a well-priced index product at under 1% annually is genuinely cost-effective for many investors. The limitations crypto index products are not without significant limitations that are worth understanding clearly. Rebalancing timing creates tax events. Every time an index rebalances, dropping an asset that has fallen out of the top 10 and adding one that has risen, that is a disposal of the outgoing asset and an acquisition of the incoming one. In most jurisdictions, this is a taxable event even though you have done nothing actively. For on-chain index tokens, the rebalancing happens inside the token, and the tax treatment depends on your jurisdiction's treatment of these instruments, which is not yet fully settled everywhere. Limited upside from breakout altcoins. The biggest percentage gains in any crypto cycle typically come from smaller assets that grow dramatically. A market cap-weighted index that holds only the top 10 or 20 assets will miss the highest return assets because they are too small to make the index when they are cheapest. An investor who identified Solana at a $1 billion market cap in 2020 made extraordinary returns. A top 10 index investor captured only a fraction of those returns as Solana entered the index later at a much higher price. Index methodology variation creates significant differences. Not all crypto indices are created equal. A market cap-weighted index of the top 10 is very different from an equal-weighted index of 20 assets, which is very different from a DeFi-specific index or an AI crypto-themed basket. Understanding what methodology is being used and why it suits your investment thesis is essential. There is no single, the crypto market index, equivalent to the S&P 500. Custodial and smart contract risks still apply. Even inside an index product, you are exposed to the underlying asset's risks. An index fund holding Terra would have lost its entire Terra allocation when Terra collapsed in 2022, regardless of the diversification of the rest of the portfolio. Who benefits most from crypto index products? Crypto index products are most suitable for investors who want broad crypto exposure without the time, attention, and knowledge required to select and manage individual positions, and who are willing to accept the near certainty of underperforming the single best performing asset in any given cycle in exchange for not holding the worst performers. They are less suitable for investors with specific, well-researched conviction about particular assets or particular thematic plays, AI crypto, DePIN, liquid staking, where a targeted allocation may be more appropriate. They are particularly well-suited to investors who already have a DCA strategy in place for Bitcoin or Ethereum and want to add broader crypto market exposure without dramatically increasing the complexity of their portfolio management. The takeaway: crypto index products offer a systematic, diversified approach to crypto investing that removes the need to select individual assets, which is genuinely difficult even for professionals, in exchange for capturing broad market exposure at a defined cost. In 2026, a growing range of on-chain index tokens, regulated institutional products, and exchange-traded products make this approach accessible across different investor types. The fundamental logic of indexing, that broad market exposure at low cost outperforms most active selection over time, applies to crypto as it does to equities. Whether it is the right approach for you depends on your investment goals, your conviction about specific assets, and your tolerance for the operational requirements of managing individual positions. As always, this episode is purely educational. We are not promoting or endorsing any index fund or cryptocurrency. Do your own research before making any financial decisions. If today's episode helped you understand crypto a little better, follow the show on Spotify and leave a rating. It helps more beginners find us. Next time on Crypto for Beginners, what is the Lightning Network Bitcoin scaling solution for payments? That's next.